Good morning and welcome to what should be Thursday's Join the Dots. I'm saying that because we're recording this on Tuesday, so the markets might be very different on Thursday to what they are at the moment. At the moment I'm looking at the S&P futures down 68, gold at 4,000 give or take $1, silver at 48 give or take 10 cents, XRP right down at 224, but also Bitcoin right down at 104. The VIX is at 99.82, which is significant because if the VIX can get over 100, it will relate to lots of things I'm just about to talk about. And we have the dollar yen at 153.42. Okay, now those are all relevant because I'm now going to talk about Eurodollar University's presentation of on the ongoing repo, let's call it instability. We won't call it a crisis yet because it's not a crisis, but it's unstable and it's volatile. And a repo volatility generally tells you you've got a problem. Okay, it may take weeks, it may take months, it may take days, but generally you've got a problem. The repo market is a very, very huge structure that when something falls out of line, something is fundamentally wrong. Not something is just temporarily wrong, something is fundamentally wrong. As we saw in 2019, when the repo crisis repo rates went completely manic for a while. But fortunately the world, or I don't say fortunately, the world suddenly found itself in the middle of a pandemic, which meant the governments could print any money they wanted and no one had any reason to ask why they printed it. And the repo instability, volatility, warnings were, well, they subsided because there was too much money around, so it didn't matter. So we come on here and all of those numbers I've given you relate to what I'm going to talk about, because here we have, and I'll link the Eurodollar University piece from Jeff Snyder, okay, the spare cash, after 3 minutes, the spare cash was lent to the Fed at a far lower rate than the repo was offering. No guesses why. Fears of loss. Now this is banks putting money into the Fed, and they can put it out in the repo market, but they're not. They're not putting it out there. They're giving it to the Fed and they're saying, no, I'd rather give it to you at a lower rate than I would put it into the market and not know who's borrowing it. This is the key, not knowing who is borrowing it. Because what we're seeing throughout the system with Primavend, with First Brands, with Tricolour, with all of these, with the two banks that collapsed, Western Alliance and the other one, Zions, all of these are basically canaries, aren't they? They're all telling you something's wrong. You don't get banks collapse unless something's wrong. So they're all now it could be internal, or it could be external, or it could be market. So what Jeff does is he examines this because it appears that now that the repo rate and the SOFR rate are rising because banks are not wanting to take the risk of just putting it into a general market where it can end up at any other bank, because they don't trust all other banks. So they're putting it with the Fed and earning a lower rate. It's pennies you think, but it's not. It is psychological. Psychological. So there's a fear of loss growing in the market. There's a fear of risk, and the risk return is wrong, putting it out into any borrower who comes to the market. They would rather accept a lower rate and know that the Fed is holding it. This is crucial because it's all about the transmission of money. Everything is about how money flows through the system. Even the stock market is all about money flowing through the system. Okay, regular monthly investments for 401ks, etc., etc. There's always money coming into the system, and it's only when net money goes out does the market start to boom. Now the S&P is down 68 today. It's just one day. But I've got a feeling we're about to see some very consequential moves. Now, I had a debate with a client this morning. Someone sent me a piece and said that there's a huge investment by AWS into, let's have a look, where is it? And I thought, well, yeah, okay, this is Amazon and this is AI. And what are they really doing? What are they really doing? OpenAI and Amazon, what are they really doing? They're just moving money between them. Now, I saw a piece the other day, and I can't remember who did it, but I thought, oh, that's interesting. And I thought about it. And when you see all these billions moving around the system at the moment between the AI companies and the mega corporates, it's like a merry-go-round, isn't it? It's like they're all playing pass the parcel. You know, it's 10 billion here, it's 15 billion there. Today's was a huge number. I'm going to look it up now because I'm frustrated that I can't remember it. Let's have a look at this amount. So, and who it was. OpenAI and AWS. And I thought, who's AWS? Don't even know. Amazon Web Services. Just signed a 38 billion deal. Okay. Yeah, but this is just money moving between about 8 or 9 corporates, isn't it? It's just, we'll sign a deal with you for 38 billion. We'll sign a deal with you for 50 billion. We'll sign a deal with you for 25 billion. Net, what is really happening? I don't think a lot. So I think it's an illusion. Now this is backed up by what Jeff says is going through the repo market. So we've got this, liquidity is under pressure now. And it will be because people don't trust the system to have safe collateral. Think of Tricolour, think of First Brands, think of Prima Vend. The collateral and the telecoms company that BlackRock have become a victim of. Okay, the collateral in the system now is being questioned. It's not all bad, but some of it is bad. Cockroaches. Remember Jamie Dimon said there's never one cockroach. So now people can't put their money into the system and just rely on it to come back again the next day. They actually give it to the Fed and say, I'll take a lower rate, thank you very much, because I don't need that risk, not for another 0.25%. And the SOFR rate is now up to 422 yesterday. Well, 422 is very, very high because the Fed rate's 4. So therefore, it's telling you that the market doesn't trust the market. It doesn't trust the collateral that's within the market. Therefore, the transmission of money starts to stutter and it can't just move freely like it does every other day of the year. Okay, so 7 minutes. Watch the flow chart, please. Okay, good explanation. When it works, it works. When it doesn't, chaos. And we will, I think, have chaos. Because I think we're beginning to realise just how many cockroaches there are. Well, those who are thinking. Those who aren't thinking just see Amazon passing 38 billion to OpenAI and OpenAI passing 50 billion to Meta and Meta passing 70 billion to Google and Google passing 100. No. They're all deals. They're all signed. Who's actually paying the money over? It's just PR. Narrative, there's the word. So jobs go globally. Yes, they do. Because when there is no money transmission through the money markets in a normal way, jobs go. I keep coming back to jobs. So in 9 minutes, he talks about the 2008 crisis reports, showed that a failed repo system was absolutely crucial. And it showed that the Fed, despite all its narrative, has no tools. The only tool in the Fed is Jerome Powell. Seriously. Because he's the one who spurts all the nonsense to you about having tools in his locker. He has no tools, except all his staff, who can't actually tell you that subprime was going to be 3.4 trillion, but told you it'd be 50 billion. A factor of 68 wrong. The Federal Reserve, all those staff, that beautiful building, all that money being spent on renovation, haven't got a clue when it comes to a crisis. But when it comes to any other time, it doesn't matter whether they have a clue, does it? Because it doesn't affect anything. But when there's a crisis, that's the one time you want the Fed to be proactive, to be in control, and to have tools. They don't have any. So 9 to 10 minutes, the massive and unpreventable feedback loop when the money transmission stops. Risk aversion breaks the system. It stops the transmission of money. Okay? We're rapidly approaching risk aversion as more and more cockroaches appear in private credit, private equity, commercial real estate, autos, student loans, and now we're beginning to see it in residential mortgages. All right. So why would any bank put their money in and just say, oh yeah, put it where you like, I don't mind, I'll get it back tomorrow, no risk. No. They said, no, I'll leave it with you, Fed. Yes, I'm getting lower rates, but and I'll get it back tomorrow. Okay. So the amount of reserves that the Fed has is absolutely irrelevant because in fact the more reserves they get means the more people are not putting their money out into the market. So it's a sort of negative sign rather than a positive sign. Jobs. Rising dollar value. Now, I've talked about this because about 3 months ago, I said to people that the dollar would rise. And all I saw on my feed every single day, 20, 30 articles, dollar's going to crash, dollar's going to be worth nothing, blah, blah, blah. And I said, no, it's going to rise now. It's going to rise. It's bottomed. And now we see it rising. And today, the Dixie, 99.82. It's at a very psychological number now, because when it goes through 100, that could cause a lot of money to start understanding the problem. And of course, the weaker currencies and the weaker economies of the world then get hit as the dollar rises, okay, because imports becoming more expensive. They've had a good run as the dollar came down from about 110 on the Dixie to 97. It's now 99.82. It's moving up. It hurts the weaker economies. Okay, risk aversion equals stronger dollar. Yes, because we're seeing the market tighten, the dollar will tighten. The dollar will move up because risk aversion will take you back to the dollar at the end of the day. Would you want to be in Chinese yuan? Would you want to be in Japanese yen? Japanese yen now 153.42. Would you want to be in there? Would you want to be in the pound at 130? With all the problems they've got. And let's just talk very briefly about the BBC, who've been, and I'm going to link this. Please understand this, because you have to understand the difference between narrative and truth. The BBC have been exposed today, well, yesterday, for a massive fraud, really, because what they did was they spliced 2 pieces of Donald Trump talking on the Capitol riots, January the 6th. And that implied that Donald Trump said to everyone, go to the Capitol, and he didn't. He never said that. So the BBC have now been caught by the Telegraph, and I've linked it for you so you can see it. The BBC, the most trusted voice in the world, probably amongst all the countries in the world, has been lying, has been politically interfering with an election, has been... And what does the BBC offer you? Fact checkers. So what use of fact checkers when the actual BBC is producing a lie on a global and globally important scale like the American election? What does it tell you about their fact checkers? This doesn't stop this story. This will go on. There will be heads to roll. So why the Fed will have to stop QT and restart QE? That's what's coming. And again, it's another signal for you. Okay, when you see that signal, when the Fed stops QT and says it's got to restart QE, it knows. Okay, so I can almost stop there. There's an awful lot more I've written here, but at the end of the day, what's the conclusion? The conclusion is that the stock market now, on a risk-reward basis, is all, to me, it is 95% risk, 5% reward. I can see maybe a little more push if they start the QE program. I could see a little bit of excitement. But the risk now is maybe 50, 60, 70%. And I really think that. And people like Manarino have said for a long time, they can see the Dow at 8,000. Where's it today? 44, 45, 46, 47, 8. Think about that. Think of the consequences. Okay? Escalating money tightness is now out in the open. Now, this is a great bottom line, because what it means is the whole world now can see that there is escalating money tightness. And this is something that people who invest in equities cannot see because they don't understand the banking system. And it's the banking system that drives everything. It is not whether Amazon sign a piece of paper to say that they might pay AI 38 billion over the next 500 years. Okay? That is narrative. That's narrative. The reality is the money markets. The reality, the money moving, mega money moving daily, is screaming, Houston, we have a problem. So risk reward is stacked against equities, and it's stacked in favour of gold and silver in the end. But we may have some bumps in the road, but the journey is 100%. Thank you very much.